Large number of requests for debt restructuring have been going to record levels, and bankers are clearly worried. They want to ensure that promoters don't misuse the facility of corporate debt restructuring when times are bad. Anirudh Ghosh and Simran Gill find out what measures banks are planning to take to keep their risk and exposure on the lower side.
Corporate loans worth at least 2 lakh crore rupees are facing the risk of turning sour, giving bankers nightmares. But the bigger concern, of course, is the fear that some of the promoters may be misusing the restructuring facility. Bankers now want the promoters to share a larger burden of the costs involved. They say the upfront contribution of promoters should rise from the existing 15% to 25%. They also want promoters to be made more accountable and could ask them to pledge their entire holding during the CDR. Banks may now insist on a board seat in companies undergoing restructuring. Another suggestion is for an exit window for companies that are doing well by paying a predetermined amount. Despite their reservations, bankers see CDR as a blessing in disguise, since a significant majority of restructured companies have been nursed back into shape.
About 15 to 20% of the restructured book turns into NPA, and out of that 4 to 5% is the eventual loss.
Restructuring does not mean bad quality assets, because most restructured assets are performing when they're restructured first of all. All restructured assets are performing at the point of restructuring, and they tend to perform thereafter as well.
Analysts feel the norms governing debt restructuring in India are among the most lenient and heavily tilted in favor of promoters. Clearly, the new norms would seek to set the record straight. Simran Gill and Anirudh Ghosh, ET Now, Mumbai.